Get out now. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, this is my most important video of the year, as we are now confirmed to be in the early stages of a major market crash. I'm going to show you the catalyst which kicked this move off, what's going to send stocks even lower, just how far I think stocks can fall, and how you can make a fortune on this move. And speaking of making a fortune, I'd like to welcome our sponsor for today's show, Asia. You can find them on the NASDAQ under symbol FAAS, and they are the first embeddable fintech as a service company in Indonesia. And when this market correction is over, their stock you're going to definitely want to take a look at. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over to Bloomberg, where we picked today's story up as we see the headline, Global Market Sell-Off, as the Magnificent Seven post record drop. And this is something that most investors did not see coming, because we've noted that this is the biggest bubble in the top 5 to 10 stocks in history, which means more investors around the world are crammed into these, and now they're selling off in a major way. But this move isn't over. Despite the fact that people came in and bought today's dip, I'm going to show you exactly what you need to know as far as why stocks are about to sell off even more. And with that, let's head back to our Sunday show where we talked about the CTA positioning. Now, if you're not familiar with what a CTA is, it is a machine that trades price level based on the momentum and direction of the stock market. And so they trade lots of money, significantly large amounts of money. And when they start to sell, they sell extremely fast and can drive the market down. Now, one of the challenges here is every major investment bank has these machines, and well, they're about to sell, as you're going to see. As we look at the data from Goldman, keep in mind, over the next month, if we see a continued decline in stocks, and I'm going to show you the levels here, we could see 225 billion of global equities. Now, keep this in mind. August is already historically a month where there's outflows in equities to begin with. This is the worst month of the year, and now we're going to see the machine sell. We're going to look at these key pivot points here on a chart in a minute, but let's take a look then at Nomura. They noted that under 52.67, their machines go into the next round of selling. So here we're seeing is all of a sudden major investment banks saying, look, our machines are going to start selling, but they're not the only ones. When we take a look at systematic positioning across U.S. equities, we have the CTAs, those trade price levels. We have risk parity, which could try to balance the risk between stocks and bonds. And then we have volatility control funds. And these volatility control funds are very interesting. As volatility goes down, they take on a larger and larger position in equities. So when stocks go down and volatility goes up, well, they are forced to sell. Again, these are all programmed machines. Now, let's head over to my charts here, because I want you to see these price levels. We're going to look at the S&P 500. Now, today's dip, we saw this gap down, and you see this green candlestick. What this means, and I'll zoom in here so you can take a look at it, is that buyers came in here because the volatility index shot up. And you'll see these lines here across the horizon. This is Goldman's first signal. This broke the other day. This is why we saw selling on Friday. See this red line? That's Nomura. See this gold line? That's Goldman's mid-level target. If it does not close above these two lines today or any time, this is the worst part, not just today, not just tomorrow, not just this week, anytime this month, you're going to see all those machines and that of other investment banks trigger a next round of selling. Now, Goldman notes that if they get down here to risk above 4,800 and it breaks that, that hits their long-term trigger. And here you are in a month with no liquidity that could see a massive selling as vol control strategies and risk parity and everybody else unwinds. How deep could this end up? How would you believe down to 4,100 as the next major leg of support, suggesting that we are now at the beginning stages of what is going to be a massive sell-off, particularly if the S&P does not close over those levels today. And as the time we're recording this, and that was a live shot, it doesn't look good. But let's talk about what kicked this move off, because oddly enough, we have to head over to Japan. As intensifying yen rally sinks Japan stocks, rattles global markets, and looks to trigger what could be one of the biggest unwinds that we've seen in over a decade. The sharp appreciation of the currency, which has gathered pace since the Bank of Japan increased its interest rates on July 31st, rumbled through global markets as it upended countless investment strategies that were built on cheap borrowing in the yen. And that's what happens when you find out these central banks take extreme policies, is that traders and hedge funds and large strategies take advantage of this in a very small way. They just keep at it. They take leverage because they never think it's going to come unwound, or if it does, they think they have time to unwind it. This time the Bank of Japan says, look, we care about our currency, and yes, well, they do, and now they're sacrificing literally the global markets as all these strategies come unwound, and what that's doing is causing margin calls, forcing them to sell other assets, such as stocks. And it's a bitter outcome for the BOJ, which had taken painstaking care to gradually nurture inflation and then recalibrate borrowing costs without jolting markets. Well, it didn't work at all, which is fairly common with central bankers. They never get this right. They take extreme moves all the time, and then they try to back off of them thinking they've got it right, and next thing you know, everything eventually comes unwound. And yet the impact of the shift in the yen has hit global carry trade far more than many market participants have anticipated, because they didn't realize how many people were running this carry trade. And everything is in the unwinding of the yen carry trade. The timing of the Fed cuts and the U.S. employment are not that important in comparison. We're categorical on that one. The rise of Japan interest rates are changing the game rules because, again, nobody thought they were going to do it, so they took outsized leverage bets on it. Now they're losing and forcibly unwinding, and now they're about to trigger the machines, the CTAs to sell, the risk parities to sell, and with volatility up, well, those vol strategies, they're going to sell too, and these strategies are indiscriminate. They're computer programs. Nobody overrides them. They just sell when they're told to sell, and they hit their trigger points, and that means in a month where we already see outflows, we could see mass selling. Enforced selling among retail investors also appears to have played a role in the swift downturn in the Japanese stock market, as retail investors' margin buying position rose to an 18-year high. And again, you see people getting squeezed here, even as the Nikkei slipped from its historic peak. What we then appeared to see was forced selling from retail investors. They seem to be damaged. And while it's possible that we are reaching a selling climax in the near term, I can't be sure. The reality is we're not there yet, because now we're about to see the machines start to unwind, and they trade hundreds of billions of dollars. And when their trigger point says sell, well, then they start selling. But if you think the Fed's going to run to the rescue, well, not likely. As Goolsbee says, Fed less reactive than markets, and they're not going to overreact. And keep in mind, the Fed doesn't really care much about the stock market until it really becomes a problem. As we've talked about before on the show, the Fed really cares about two-year Treasury yields, which, while they're down some right now, we're not seeing them down enough to cause the Fed to react. In fact, Goolsbee goes on to say that a worse than forecast U.S. jobs report on Friday, which capped a soft week of data, spurred recession concerns and helped drive a global stock rout. But he said there's some cautionary indicators like the rise in consumer delinquencies, but overall, and we have data today that suggests that economic growth here in the U.S. continues at a fairly steady level. Keep in mind, they believe in the power of the Fed. They believe in the power of their abilities, and they think that we are still about to experience a soft landing, perhaps delayed from their initial target, but they still believe it, and I'll show you why. As you see, job numbers come in weaker than expected, but do not look like a recession, Goolsbee says. I do think you want to be forward-looking of where the economy is headed for making the decisions. Of course, we've made the case on the show that the labor market here in the U.S. is likely to come unwound in a big way, but perhaps there is something of a Goldilocks news in today's story. There's a silver lining that perhaps will change consumer spending habits. I'll show you that a bit later, but if we blow through normal, if we're in a different situation, he says, and we would, in my opinion, we would need to react more robustly, sending in, of course, what could be a 50 basis point rate hike. But will it be soon enough to appease the markets? No, but think about this. If there is a major correction and we do get a 50 basis point cut in September, well, you could see a big reversal in the market coming after that, heading into the election. But as we talked about, we now have some new evidence that perhaps the U.S. economy just isn't as bad as now the market's suggesting. As we turn to the ISM Services PMI, that's Purchasing Managers Index, that came in at 51.4. Now keep in mind, over 50 denotes an expansion. Now mind you, it's a very slight expansion, but underneath, the report was pretty good. As we look at business activity and production at 54.5, that's good. New orders now growing, 52.4. This shows that there's demand for services, and that brought an increase in employment at 51.1. Not much, but very slightly, and even backlogs moved up from contraction to 50.6, indicating that the existing services workforce isn't big enough to actually handle all of the new orders in the backlogs, suggesting that perhaps the services sector is far more resilient than what we're seeing in the manufacturing sector. Now keep in mind, historically, we already know that where the manufacturing sector goes, the services sector eventually follows, typically with about a 3-month lag, and it's simply because the wages of the manufacturing sector are so much higher on average that when those jobs go away and the spending power of those workers goes with it, well, the services sector eventually follows. But the S&P Global echoed the ISM. As they say in their report today, activity rises markedly again in July. They note an increase in new orders and second successive rise in employment. And while we see sharp input cost inflation, output costs are rising at a softer pace. Let's look at some of the details here, because where output increased, companies often link this to higher new orders, as new business rose for the third consecutive month and at a solid pace, albeit with the rate of expansion easing slightly from that seen in June. Although according to respondents, customer referrals have played a role in them being able to secure new business during the month, and that's giving us some confidence that perhaps maybe the Fed is not overreacting here. Now, what do we know is actually going to happen? We're going to see a big sell-off. People are going to panic. Even the Fed's going to get nervous, but they may come out with a 50 basis point cut in September. Look for that to be a monster catalyst, because the market's going to believe every bit of it. As a positive projections for the coming year, allied with a solid new order growth in the latest survey period, encouraged companies to take on an additional staff as the second half of the year got underway and employment increased for the second month. And the modest increase in employment was not sufficient to fully keep up with new order growth in July, resulting in a second consecutive monthly rise in backlogs of work. The rate of accumulation in outstanding business was only slight though, but still gives the Fed some indication that maybe the economy isn't that bad and we're only just seeing a manufacturing recession. But what could give a boost to consumer spending power is something the Fed has been hoping would happen, and that is a big decline in oil on the back of this major move down in markets. As oil slides to fresh 7-month low as global rout deepens slump, let's take a look, because Brent futures slipped below 76 a barrel, whereas West Texas Intermediate dropped a little above 72. Now keep in mind, it's been above 80 here recently as a global rout in equities worsened on Monday, flagging concerns around economic growth. And the decline is weighed on an oil market that's already signaling concern about the health of demand in China, the largest crude importer in the world. And speculators have added to the slump, with money managers slashing bullish bets on global Brent benchmark by the most since 2022 last week. They also have the fewest wagers on rising gasoline prices since 2017. Now keep in mind, consumers here have been really pinched by rising energy prices on the fact that they've also seen their insurance costs goes up, not to mention that service costs remain elevated. So this could give consumers a bit of relief, and that would be a huge boom. In fact, the Fed will be watching this, and it's great news for inflation, because here we can see the link between oil prices and gas prices as we look at West Texas Intermediate in blue against U.S. regular all formations gas prices in red, both on a year-over-year rate of change here. And we can now see that West Texas Intermediate on a year-over-year rate of change is negative, along with gas prices, suggesting that if we see a further decline in West Texas Intermediate, gas prices are coming down, giving consumers a little bit of relief here. And what that means for the consumer price index, well, it's great news for the Fed, and this is actually now will help set up that 50 basis point cut or any form of cut in September, as we note that there is a strong relationship between gas prices and the consumer price index. Here we see gas prices rolling over, heading down already on the back of the fact that the consumer price index is headed lower, which suggests that indeed things could get a little bit easier for U.S. consumers. Now, I'm not suggesting this is going to be the game changer, but the Fed's going to look at this and say, wait a minute, inflation's coming down, consumers have a little more money to spend, look at the services sector, this will all turn around. The question is, will things get far worse by September that causes the Fed to panic? Well, it's possible. The global stock markets are still under strong downward pressure, and as we're making the case in today's show, it's only going to get worse, which could mean that the short-term risk is further price drops. The central theme for the oil markets is fear that the American economy is seriously slowing down and maybe even heading into recession. Well, there's no doubt we are, even though the fact that many people don't actually believe we're heading into a recession. But let's take a look at why this decline in gas prices could be a boom, not just for services and employers, but for, of course, the manufacturing sector as well. As we take a look at advanced retail sales in blue against U.S. regular all formations gas prices. Now, gas prices were showing in dollars per gallon, retail sales on a year-over-year rate of change, and you can see when gas prices come down, this tends to help stabilize and sometimes put some upward trajectory on retail sales. We see that happen here around late 2005 and right into roughly 2007 as the decline in retail sales was reversed on the fact that consumers had more to spend. In fact, even in the global financial crisis, falling crude oil prices put an end to the decline in retail sales. We see this event happening repeatedly over the time, including right around 2019. And even today, we see, of course, a decline roughly earlier this year in crude oil that helped revive retail sales. Could it do it again? Well, the Fed will think, yes, it can. And with the data we're seeing on the services sector, you'll note that, of course, Goolsbee said they're not too worried about this unemployment report because it's just one. And they like to see about 3 of them. Of course, we'll have another one before the Fed meets in September, but the question is, will there be enough other economic damage, or will this just be a correction in the markets, or at least a sizable one, that it turns out to be a tremendous opportunity? We'll find out in, of course, mid-September what the Fed's going to end up doing, and we'll be watching the data along the way. But you can see the effects here, how U.S. regular formations gas prices really help consumers, because when we look at total compensation, shown as average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, you'll note that when, of course, consumption is going down in general, and the fact is that's on the back of total compensation falling, what really helps consumers is a decline in gas prices. It gives them more spending power, and that's what the Fed's going to see here, that is going to help potentially turn around retail sales and bring inflation down to their target and give them some leeway to put in perhaps maybe at the very least a quarter basis point cut in September, just to say, hey, look, everybody, we got this right. But when we turn back to the banks, the ones who run these machines, well, they're going to be a part of the story that's going to turn everything around as well. Because Goldman economists lift limited U.S. recession risk to 25%. Of course, if you don't think that these big investment banks want to see a sell-off here, oh, they do, because you know they're going to come in and be buying this and then turn around and sell it to everyone and get them to come back in after they've sold and lost money. Watch this. As we continue to see recession risk as limited, the economy continues to look fine overall, and there's no major financial imbalances, and the Federal Reserve has a lot of room to cut interest rates and can do so quickly if needed. And that will be the story when the market goes down and all these machines sell, is no, wait, we're not in a recession. It's okay. They'll come in and get everybody that's sold to buy back. And of course, you know the banks are going to make a fortune. That's why we're going to show you, and it's why I'm giving you the data so you can do that too. Again, links in the description below for our reports and for our sponsor. As the premise of our forecast is that job growth will recover in August, and the FOMC will judge a 25 basis point cut as sufficient response to any downside risk. If we're wrong and the August employment report is as weak as July, then 50 basis point cut will be likely, and that will be all the catalyst that these investment banks need to go out and tell people that the market correction is over and now's the time to buy. Watch it happen. Because as we sit here today, right now, filming, we're on the cusp of the machine selling into a very illiquid month. But again, this is about opportunity. We give you the tools. Again, the links are in the description below for a free 30-day trial. But while you're there, check out our sponsor of the show, DigiAsia. Again, they're the first embeddable fintech as a service company in Indonesia, and they are creating some waves here. They just made some major moves. Let's talk about who they are and what they do. Again, everything in the pinned comment and description below. They offer financial services including closed and open loop wallets, QR payments, cash-based and digital remittances, person-to-person lending, corporate cards, merchant-operated ATM branch banking functionality, and card issuance through a set of open access APIs. DigiAsia offers its partner customers, including banks and non-banks, access to bank products such as virtual accounts, prepaid cards, forex transfers, card issuance covering prepaid and debit credit cards, cardless withdrawal at ATMs through white label products. And given the deep integration on various fintech products, DigiAsia enables our partners, customers, access to leading edge products and both in-house products of loyalty program management, deep analytics for revenue optimization, and that is what makes them a future superstar in Indonesia, and you can take advantage of this as their platform and ecosystem connects more than 200 of Indonesia's leading enterprises with a network of over 1 million active merchants to accelerate B2B and B2C e-payment adoption, product and payment flow, working capital efficiency and fraud management. DigiAsia's fintech solutions serve major industry players such as Starbucks, Unilever, Garuda, and KAI, Indonesia's national railway. Southeast Asian government entities rely on DigiAsia to handle cross-border transactions, and leading financial institutions such as DBS and Citibank serve as lenders that permit DigiAsia to bank the ecosystem. Now let's talk about some of the recent announcements as they advance into AI solutions for financial services, telecom, and government sectors with NVIDIA GPU allocation, and they now have secured an allocation of an initial tranche of over 5,100 NVIDIA H200 GPUs. And the first iteration of these NVIDIA-powered solutions is expected to be deployed by the fourth quarter of this year. And this will help DigiAsia base operations for its AI initiatives out of the Dubai International Financial Center in the UAE, leveraging on the UAE and the DIFC's global leadership in the advancement of AI solutions. And they recently announced year-over-year transaction volume growth of a whopping 74%, keeping with its strong growth trajectory. And now the company has moved into operational profitability as they have had 7.85 billion transactions for the full year of 2023. They have 3.625 billion gross transaction value for the full year of last year. They have 1 million total merchants on the platform, a growth of 31.5%, and a 40% increase in enterprise payment and banking partners on the platform compared to 48 customers in 2022. And they formed an AI-focused strategic advisory board and appoints Gulzar Azad as strategic advisor. And here you can see Google's India's country head of conductivity joins DigiAsia's guide to the development of AI infrastructure. And they announced that Gulzar Azad, an accomplished technology leader and entrepreneur, is DigiAsia's first appointee as a strategic advisor to its recently established AI Strategic Advisory Board. DigiAsia's formation of an advisory board serves as a critical purpose in navigating the trajectory of the company as it rapidly introduces AI technology and capabilities to provide efficiency to enterprise clients in Indonesia at scale. Mr. Azad's motivation to democratize technology through innovation will significantly benefit DigiAsia's initiatives to build its AI infrastructure and the AI as a service business. And Gulzar Azad added, "I am excited to support DigiAsia in this new capacity as my history and close experience with its advancing technology equity and creating distributed architectures to benefit the broader ecosystem is complementary to management's mission to drive commerce growth across Indonesia and its trading partners in Southeast Asia. Together, we'll work toward democratizing AI infrastructure, ensuring it benefits a broader range of stakeholders and fosters innovation across various sectors." So as you can see, DigiAsia is set to become a major player in Indonesia, and you can be an early investor in this company. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.